So I've been pretty busy with real life lately for about the last 10 days or so, and as such, the world has been spared my commentary on why the market's plunged and everything else that I generally have been posting about, which isn't necessarily a bad thing, but it's the way these things go. Today I'm going to change that, and we're going to dive in and do kind of a review over the last week and a half or so and figure out exactly what's going on. So there are a lot of drivers at play when we start looking at issues such as this, where all of a sudden we start seeing multi-percent drops in silver and gold and things like that. And it's really easy to get caught in this perspective that there's some simple explanation for it, that someone is manipulating or shorts or selling or whatever it happens to be. I mean, I spend a lot of time on various groups of this nature, and there's never any shortage of, the mythos around what's going on, why it's happening, anything like that. It ranges everywhere from JP Morgan is doing it to, because of course they were just fined, $900 million, blah, 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 everything else, all the way down to, simple kind of conventional wisdom of, well, the dollar's strong, so, silver is short or gold is short or something like that. We live in a very complex economy. It's not that simple. Generally, you can't answer a complex question with a simple answer. I mean, there are certain exceptions to that rule, but for the most part, when you're looking at broad-based economic conditions that are as complex as what we're dealing with, you can't just point to one single factor and say, yeah, this is what it is. So you have to kind of dig in a little bit deeper. I've always believed that as you start digging into the details of these things, that's where you start to get the revelations. You start to understand a little bit more of the dynamics that fall into place. What little element, when you push on it, creates a certain response. And it's never just one big lever that you can pull and say, okay, well, if we pull this, then the movement is going to be whatever it happens to be, either up or down. It usually comes down to a circumstance where you start looking at things and saying, okay, well, here's this little detail, here's this little detail, here's this little detail. Now, if we add all of these up into an aggregate, then we start to see a causality that occurs. That's a lot of what I try to get across within this channel. And oftentimes it doesn't always come across. It's very easy to get lost in, the trees for the forest, that type of thing. I go through a lot of charts, I go through a lot of graphs, the reports, everything else. So there's a lot of information that I'm throwing. But generally it's always looking at these individualized aspects of it so that we can start to really define what are the movements that happen, why do they happen, and what are these little levers that we can pull to start to figure things out. And it's not necessarily with the goal of timing the market per se. No one can time the market. No one's going to know when some random firm is going to all of a sudden dump 10,000 futures contracts, which is going to tank a price, which we just saw recently. What we can, however, time, or what we can at least allude to, are periods of storms. What do we have to look for the price to take a dive? What do we have to look for the price to start appreciating? Things of that nature, so that we can start to discern what the guideposts are as we start to move forward. And that's really the important part. The better that we can define kind of what the lay of the road is, that's what we start to look at being able to make more informed and better investment decisions. And that's the entire point. No one's going to get always 100% right. No one's going to get 100% wrong. I mean, dumb luck factors into it. Black swan events factor into it. All of these various things. The best we can do is really lay out what's going on, how it's happening, and really just providing the data to make informed decisions. So with that, let's jump right in and start to really pull apart the last couple of days and see how long this is going to last, what we need to look for recovery, and what all of that kind of looks like. So real quick, let's jump into last week's reports, because one, I didn't cover them, and two, I think that there's a lot of information in here that really tended to have gotten overlooked as we were looking at the data of why prices were the way that they were. So we started looking up on Monday, August 2nd. Last week was a lot of manufacturing reports and some really good numbers that popped out that all led pretty much into Friday. That was really the big numbers. But as we can see, the two columns that we really want to look at are going to be previous and actual on all of these. As we start looking at things, so the market manufacturing came out on Monday, which was the final number, and we had a slight increase over the inventory numbers that were being purchased. The manufacturing index, we had a slight decline. roughly about, 1.1 points. Construction spending, we had a 0.1% increase. So that was actually pretty good. They didn't really hit the expectations, but they were still relatively positive. As we started seeing, factory orders were up over the estimates, although they were down from the previous. Core capital goods orders, they were up by, 0.1%. The real household debt was an interesting number because we saw that although in the previous year, because this is a year-over-year change, in the previous year we had a 0.5% increase in real household debt. For this year, it's held steady. So there really hasn't been significant amounts of additional debt that's been added. As we get into motor vehicle sales, we can see that those have dropped a bit. So we're about 600,000 underneath what the previous month was, which again, that factors into significant areas of supply, especially the computer chips, because there's been a significant shortage of computer chips that are available from Asia and overseas because of production problems and other aspects like that. So that definitely affects the supply involved in being able to get motor vehicles, as well as how many are being sold and how many are moved. So that all drives into it. And of course, as you may realize, computer chips contain a lot of gold and silver and other precious metals. So that all kind of falls into place with a significant weakening in what we're dealing with. Now, the ADP employment report, this is where we saw our first major drop. And this is really critical because previous period in June, we saw 680,000 jobs that were reported by ADP. Analysts were expecting 653,000. We wound up with 330,000. That's a huge number, and a specific hit on that was the manufacturing side of things. So as we saw that drop, that constitutes a real shortening or a softening of really the positivity as we start going into the September delivery, as we start looking at the end of the year totals, things like that. If you can't get labor, you can't produce goods. If you can't produce goods, you can't get the money, you can't get the orders, things like that. So that was a big thing, and that caused a drop that we saw last Wednesday, and that was commonly accepted as what it was. Now, as we start moving down for the Wednesday reports, we start seeing the market services from the Purchasing Managers Index. That was right on line. That was actually up by about 0.1%. But again, according to the ADP report, the strength has been hospitality, there's been strength in service, there's been strength in retail, things like that in terms of where the bulk of these job additions were coming from. Adding additional, that's not a big surprise. The services index, that actually rose quite a bit above analysts' expectations by 3 point some percent. Getting into Thursday, we can see that the job numbers were pretty good in terms of initial jobless claims, as well as the continuing jobless claims. They're all holding steady, they're declining. It isn't too bad. I mean, these are the headlines that you're getting as the economy's improving, jobs are coming back, things like that. And it's always the devil in the details. As we get into the trade balance, we can see the trade balance increased. It went to a negative 75.7 over the previous period was negative 71 billion. So we did have a few billion that got added onto that. But this was the big number that really dropped at the end of the week. And this was something that on its surface, it looks pretty positive. The previous period was 938,000 jobs that were added on non-farm payrolls. Analysts were expecting 845,000. We actually wound up adding 943,000. But again, the devil's in the details. As you break into that number, most of that was in hospitality. It was in retail, it was in services, it was in things that weren't directly related to metals. So if you happen to have a company in those sectors, you're doing pretty well. That's why we saw the market increase. Well, all of a sudden we saw silver and gold and precious metals really decline at a significant pace. One of the things that we had found is that really we had only added about 27,000 manufacturing jobs, which is down from the previous 3 months rolling. So it really signifies a lot of that continued weakening. So these two reports, the non-farm payrolls and the ADP employment report, they both went hand in hand. And they both created that synergistic decline that we had seen. And then, of course, the employment rate or the unemployment rate had decreased a bit to 5.4%. Average hourly earnings had gone up by 0.1%. Wholesale inventories had gone up more than analysts' expectations, down from the previous period, but still it was an increase of 1.1%. And of course, consumer credit, we were pretty much we were expecting a decline, but we went up. And again, those last few numbers aren't necessarily things that are going to be drivers for precious metals, but they are things that do factor into the overall health in the economy. With futures contracts, you can't necessarily look at today's numbers. You have to look at what they represent in the period that they represent them. We're currently trading, especially for silver, we're trading on a September contract. So all the prices that you're seeing reflected in spot are based off of the strength and the health of the economy at delivery for September. So we're still a month and a half away on that, and expectations are running low. So as we get into this current week, we can see, again, job openings. We increased job openings. So we added, 943,000 jobs, but we still have 10.1 million that are open over 9.5 million the previous. So we added 1 million jobs that are just open right now. That again creates that softening effect. And we saw another major decline on Monday. So the employment picture is really a major driver right now, not because of employment per se. It's because of what employment represents to manufacturing capacity, being able to fulfill orders, fulfill demand, all of these other aspects of things that go into it. So looking forward, we saw a decline in the NFIB Small Business Index. That's another number that is being held down by the difficulty of labor. Small businesses aren't able to fill the positions that they need. So therefore, it's the orders, it's fulfilling demand, all these other aspects. We had another decline in productivity. We went down, by 2 percentage points. So we're still on the positive territory of growth, but it's definitely nowhere near what we were seeing. There was a slowing of productivity. Unit labor costs, we did have a decline in unit labor costs for the previous quarter. This quarter we're seeing, we had a 1% increase, but still when you start adding it in with everything else, it wasn't that great to affect a change. As we get into today, we get into a couple of other core numbers. We get into the Consumer Price Index, which has declined in growth, but it's still growing. It went up by 0.5%, which is right in line with analysts' expectations. We saw core CPI that actually declined a bit in terms of growth, less than analysts' expectations. These are both pretty positive in terms of the way things are. However, we did see the federal budget balance. At 2 p.m. today, we had negative 63 billion in the previous quarter, or in the previous month. Now we have negative 302 billion. That in itself is a negative, but when you start looking at what analysts were expecting, at 314 billion, it was a $12 billion benefit that we saw. So things aren't quite as dire as where everything else was. And then, of course, as we get into the rest of the week, what we're looking at is, again, the initial jobless claims. We'll see if the trend is holding. We get into the producer price index. They're expecting a decline, or at least not as quick of a growth in terms of the prices. And then on Friday, we have the import price index and the University of Michigan Consumer Sentiment Index, the early report on that, which are both expected to move slightly. But these are all drivers that go into this. When I last reported on this, we were back in July. I believe we were on the 27th. We were at 1.24. We had that dip that went all the way into August 3rd, where we closed at 1.17. And now we're steadily climbing on these rates. And part of that could be indicative of the proposed tapering of stimulus by the Fed. There are other factors that go into it, but we're now in the 1.34 range, which is higher than we've seen in quite a while. We go back to July 14th, and we were at 1.37. July 15th, we were at 1.32. So we're definitely in that mid-July range right now, a month later. And we're starting to rise into it. And so we'll have to see where everything closes. So we get into the market, and this is where we can really start to define where we saw a lot of these drops and really what effect they had. We go back all the way to really August 6th. August 6th was on Friday when the job numbers came out. So 749, we're still riding in the 25s. We had declined a bit, which was to be expected. We had that previous decline, which isn't showing up on this chart because it's only a 5-day. We had that previous decline that occurred back on Wednesday when the ADP numbers were released. But all of a sudden, we started seeing we start getting into the 8 o'clock hour, and in real short order, we had that drop that popped in, which was right when the Fed had released the jobs reports numbers. And so there was an immediate reaction to that. And it doesn't take too much to really put one and one together and say, yeah, this is what happened. It's a pretty easy path backwards to figure out exactly what was going on when it was happening and why it happened. We carried through with that throughout the weekend, and then we opened up on Sunday night. We were at that 24.3, and then we had that big drop, later in the night, which really, to me, felt a lot more like holdover from the overseas markets that had wanted to do some pricing in, some challenges, things like that. It was short-lived, though. By the time we had gotten into the middle of the night, we had really popped back up. We're at 22.55 on August 8th, and we can see that the price had really risen back up to the 23.93 mark. And we continued doing that until midday on the 9th. So, midday on Monday, we're back at 23.29. We're in the low 23s, and we had dipped right below the VWAP, right below that -2 standard deviation. Even though we've had these drops, we're still adhering to these markers. We're still watching these things. It's one of those things that, I've mentioned it before, is that we start seeing that the price starts falling into alignment at these guideposts, essentially. And these aren't things that are applied after the fact. These are just the natural order of where things start to fall. But the -2 was really where kind of found its rallying point just below that, and that popped back up to the -1. And we've kind of ridden between these spaces since then, until just a little while ago, we had gotten back to just above the -1, and we're now between the -1 and the VWAP territory. And even now, I froze this chart at just after 4 o'clock on Wednesday the 11th. The price right now is at 23.53. So we're coming up on market close. We're still seeing that this line is still pretty much holding where it's at. And if we apply previous VWAP, we can see that the previous day hits right at that -1 level, so we're riding above the previous day VWAP. The intraday is just slightly higher. So we're starting to gravitate between these. Where the price is going to go, it's hard to say. That positive number on the trade balance at 2 o'clock, that did have some minor effect to it. Not significant, but traders are trading. They're doing what they need to do, and we'll just have to play it by ear and see. So gold, as we look at it, is pretty much a carbon copy. We see the same movements. So we see that movement right there. We get that point at 8.25. Really by mid-morning, the price had taken effect. It was after that jobs report. We get through the weekend. We see the same decline that we saw from the Asian markets when they were opened. We get up and we start adhering to the VWAP the exact same way. Except what we saw is today at 6:35, we had crossed over. We're now in solid -1 territory. We start moving forward, and then we crossed above the VWAP itself. So when we apply, previous day, it's riding around the same places where silver was at that -1 mark. We look at the intraday, and we can see that it rides a little bit higher because, of course, the price appreciated and volume was a little bit better. We can see that there's positive movements in gold. Is gold going to get back up there? Right now, again, we're about 10 cents higher than where I froze the chart at 1753.90. We look at all of this and say, okay, well, how long until we get back to the 1800 mark? And a big part of that's going to depend. But obviously, we can see that gold is a little bit stronger. It's moving a little bit more forcefully. It's getting into different ranges and really showing kind of more strength as it starts that climb. So I would expect that, if gold holds this pattern, and it continues the way that it is, it's going to be a long slog, but, hopefully by the end of the week, we'll see 1780s maybe. That would be kind of a nice range to be in, but of course that's all the way up almost to the +2 mark, which could be a little bit difficult. It all depends on how the reports shape up. So retail silver, we shouldn't have too many big surprises here. We've definitely seen declines, and especially on the averages. Right now, the 1 ounce generic silver, 29.12 on an aggregate rolling period. Previous week was 30.34, and then the week before that was 30.16. So we did have a slight bump from week over week, 2 weeks to last week, and now we're just facing the ramifications of the decline. And we're seeing that across pretty much everything. Philharmonics are down this week. Maple Leafs are down this week. The American Silver Eagle is definitely down this week. In fact, we're pretty decently below the $40 mark which is nice to see for that piece. 10-ounce silver bars seems to be a pretty decent deal at $28.48, just to highlight what we've been seeing. And whenever silver drops like this, there's always this huge amount of discussion and debate surrounding premiums. When will premiums drop? When won't they drop? Are they moving in weird places? You know, blah, 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 whatever. What we wind up with is on this chart, again, I track really the four benchmarks, which is the generic round, the Canadian maple, the Philharmonic, and the American silver eagle. And one of the things that we can note on this is below we can see that spot is actually down here. We can see the movement of spot in the shaded area. That goes right down to the 0% mark. And this indicates how far away each of these prices are moving on a regular basis. Generally, what we can see is as I aggregate this, you know, we're always going to start at 0. We can see that spot, even at the 10th at 6 o'clock, we can see that spot was at, you know, positive 0.06%, but the silver eagle was at 0.26%. It had actually raised a bit more. The maple 0.27, the generic 0.32, the Philharmonic 0.35. So we can see that while spot is kind of moving slowly up, we can see that there were some definite advantages that were being taken in the retail market. And especially as spot tended to decline at 2100 was at 9 o'clock, we can see that while spot was down by almost 0.5%, all of the others were up. At least 0.18%. So this is where a lot of this difference comes in, is that you don't necessarily see a variety of price movements. You don't see radical price movements, but there are small little breaks that get applied. You know, the retailers tend to tap the brakes a little bit. The price widens. They're not declining as fast as spot was. Or as spot starts going up, they might be a little bit slower, such as like right here. We start seeing that there was a slight inflection point as, you know, the spot price started to appreciate a bit. It got up to 0.43%, and we could start seeing that more and more these prices were tracking. Now, as we start reaching the end of the week, the end of the day, we can see that spot was up 0.75. Now, in the aggregate over a 24-hour period, a silver eagle was only up 0.1%. A maple was up 0.6%. Philharmonic the same, and a generic was up 0.7. So it was actually underneath where spot wound up. So it's within those balances that you start finding that, yeah, you might have incremental periods, such as like back here, where the price is actually higher than what spot would be. By the time you reach the end or the average of it, the difference is closed. There isn't quite as much, and you're starting to give back some of the gains. So that's why we wind up with this type of graph on the silver spot retail divergence, is that you start seeing these margins over time. Yeah, there's tiny little fluctuations, but overall, they tend to hold consistently. They tend to hold almost a consistent dollar margin, and the percentage margin tends to fluctuate, but the dollar margin remains the same. So it depends on what your perspective is on these things. Is it true? Is it not? You know, whatever. But we aren't seeing this huge, you know, appreciation in premiums because spot has dropped to the level that it has. This is a little piece of data that I whipped up here that I thought would be beneficial and useful for these types of reports that I'm doing, is that I take a snapshot of all of the last hour's silver prices and start to show a little bit of what the specifics are and who's carrying them. So as we can see, these are all ordered by price by default, but as we can see, we have like, you know, 1 gram Geiger squares, silver bars. They're new from JM Bullion, $3.79 each. You know, and this is all in stock inventory. This is all pulled directly from them. So this is pretty up-to-date information. But let's just start looking at what is the actual amount that we're doing. And I'll do everything that has a price greater than 20 so that we can eliminate a lot of the cruft that's involved. Something that we can see is, you know, Sunshine Minting, 1 ounce silver round. That's really the lowest price that I'm collecting right now on generic silver. And that's really what it is. So we're at $26.84 from Silver Gold Bull. Not a bad price. You know, I mean, that's, what is that, $3.30 ish over where spot is right now. So that's pretty decent premium. We start seeing, you know, silver, gold, bull. They definitely have some good prices on stuff. We see Provident with a few of them, like the Silvertown Silver Buffalo rounds, 26.94. So we can see a decent amount of silver that's available on the generic side for a pretty low premium, and it's out there. So on retail gold, we can take a look at this quick. We're still seeing the declines. We had this appreciation in the previous weeks on everything that wasn't stupidly priced. So we see like the generic 2 weeks ago, you know, it was down 1889. It went up last week to 1901 on average, and then it dropped back down. So it's 1852. That's a pretty decent discount right now. And given the strength of gold where it's heading, do you buy more? Don't you buy more? Are you going to play it for a little bit longer, see where the prices go, things like that? At this point, I'd probably play it a little bit just to see where the prices are going, per se. Whether gold is still going to be strong by the end of the week or not, and then start making the decision from there. But as you start getting into the more premium aspects of things, we start seeing, like, you know, the Kangaroo, 1863, not a bad price. All of these are pretty much not, you know, for the most part, until you get into the Gold Eagle, they're all under that $1,900 mark, really. So we start to look at that and say, wow, okay, so the prices did decline a bit. Again, is it a good time to buy? It's a good question. It's hard to say. As we get into looking at the same type of movements from the silver chart, we look at the gold to market ratio, and we start looking at it, and we can see that, you know, gold is holding its own. It's appreciating greater than the spot price until spot really started taking a definitive move upward. Right around where was that, at, you know, 8:30 this morning, it starts moving upwards, and you could start seeing that the prices started lagging a bit. You know, it was under what the movement of spot was, so the prices weren't going up as fast. They were trying to maintain that equilibrium from when they had adjusted upwards quite high, you know, at 6 o'clock last night. So by the time we get to the end of the day, we can see that gold spot is sitting at, you know, 1.36% up on the day, and the gold buffalo and the Philharmonic are up above spot, but everything else, such as the gold eagle, the Lance generic, the kookaburra, the panda, and the maple leaf, are all sitting underneath where spot was. You always have to be conscious of what you're buying, how you're buying it, how do you get the best deal off things, when's the best time to buy, you know, where is it in relationship, especially if you're concerned with weight, if you're concerned with stacking against spot and trying to really eke out the best leverage within that premium arbitrage that's there. If you're not, if you're just a collector of, say, you know, American Gold Eagles, you know, buy them when you can, that type of thing. Or say the gold maple leaf, buy them when you can. It all comes down to your specific methodology, what your ideals are on things, and really that's how you have to make your own decisions on this. Everyone stacks their own stack, and I can only provide you with some data, provide you with some insights, and try to help you understand what I'm seeing and how I'm seeing it. And, you know, primarily my focus is always on the physical. That's why I end all of these things with a physical. But as we know, and even as we see in this graph right here, these things move in conjunction with each other. They're sympathetic movements. The retail price is highly influenced by the spot price, and it's not a one-to-one correlation. The correlation isn't perfect. However, it does come into play. So it's important to look at the economics and what spot is doing and what drives spot to move in different ways so that we can judge what the retail is. So I hope that this was all informative. I hope that you got something out of this that was a little bit more than what you came with. Um, You might not have understood it all. That's fine. You might not agree with it all. That's even fine too. If there's something that I got wrong, feel free, leave me a comment. I'm more than willing to evaluate it and either rebut it or agree with it or whatever. I'm always open for new ideas and concepts on it. If you're looking at different data, if you have different numbers in mind, and you have a thought on it, feel free, leave me a comment. Let me know. I might get right. I might get wrong. Who knows? Only time is going to tell on these things. But until next time, happy stacking.